Did you know that house prices in the UK have risen by over 20% in just the last 5 years? Sounds like a dream for homeowners, right? But what if I told you that this housing boom could come crashing down by 2026? Yes, you heard that right. The UK housing market is on the brink of collapse. Imagine this. You've just bought your dream home, and in just a few years, it's worth half of what you paid for it. Scary thought, right? Well, the signs are all around us. Rising interest rates, sky-high prices, and a flood of debt that could spell disaster. But what exactly is causing this? And more importantly, how can you protect yourself? Stick around as we dive into 10 shocking reasons why the UK housing market might just implode by 2026. Trust me, you don't want to miss this. Number 1. Rising interest rates. Interest rates are one of the most powerful forces shaping the housing market. And right now, they're heading in only one direction, up. Over the past few years, the Bank of England has been gradually raising interest rates, and while this might seem like a small change, it's causing massive ripples in the property market. Here's why. When interest rates rise, the cost of borrowing goes up. This means that the monthly repayments on mortgages become more expensive for buyers. For example, a £200,000 mortgage at a 1% interest rate could cost you around £700 per month. But raise that rate to 4% and your repayments jump to around £1,000 per month, a 40% increase. That's a huge burden for a lot of people, especially when wages aren't increasing at the same pace. Now, why does this matter for the housing market? Well, when mortgages become more expensive, fewer people can afford to buy homes. Demand drops, and when demand drops, house prices fall. Buyers are no longer willing to stretch their budgets or take on larger loans, so properties stay on the market longer. Sellers, faced with the reality of stagnant demand, are forced to lower their asking prices to attract buyers. But it doesn't stop there. Rising interest rates also affect investors, those who buy homes to rent them out. Higher mortgage payments mean the return on investment becomes less attractive, especially when rent prices can't keep up with the rising costs. Some investors might even sell off their properties, flooding the market with supply and causing further price drops. In short, rising interest rates aren't just making homes harder to afford, they're putting the entire housing market on a collision course with a major correction. And by 2026, this could be one of the biggest reasons we see a market crash. The bottom line, if rates keep climbing, home prices won't just plateau, they'll plummet. Number 2. Skyrocketing property prices. Over the last decade, house prices in the UK have been climbing at a frightening pace, with some areas seeing increases of more than 20% in just a few years. For homeowners, this has felt like a golden era of rising wealth, but there's a dark side to this boom. Skyrocketing property prices have created a situation that's unsustainable, and by 2026, we could see the market come crashing down because of it. The reality is, property prices are now so high that many people, especially first-time buyers, are being priced out of the market entirely. In some parts of the UK, you now need to earn multiple times the average salary just to afford a home. For example, a first-time buyer in London might need to have an income of £70,000 or more to afford a modest property. For most people, that's simply not realistic. But what happens when fewer and fewer people can afford to buy? Demand starts to slow down, and when demand decreases, house prices follow. This creates a dangerous cycle. Fewer buyers can afford homes, so prices have to drop to attract them back into the market. When sellers realize that prices are no longer climbing, they might panic and start lowering their prices too, further triggering a market decline. Additionally, the problem is compounded by the fact that house prices are now so inflated that they're no longer linked to real wages or long-term economic growth. They've become a bubble, pushed higher by speculation, easy credit, and a false sense of wealth. Just like any bubble, when the reality of affordability sets in, it's bound to burst. By 2026, we could be facing a market correction that leads to massive price drops. Homes that once seemed like a good investment could lose their value, and those who bought at the top could be left holding properties worth far less than they paid. The skyrocketing prices we've seen in recent years are a recipe for disaster, and we might be on the verge of that disaster unfolding. Number 3. Lack of affordability. The dream of owning a home has become increasingly out of reach for many, especially first-time buyers. If you've been following the housing market, you've probably noticed that it's become nearly impossible for the younger generation to get their foot on the property ladder. In fact, research shows that first-time buyers now make up only a small fraction of the market, and this trend is only getting worse. Why? Well, the combination of sky-high property prices and stagnant wages has created a situation where the average person simply can't afford a home. In many areas, the cost of a first property is now 10 times the average salary, which means that unless you're making six figures or have financial help from family, home ownership is slipping further out of reach. But it's not just the high prices. The cost of living has risen sharply in the UK, with inflation eating into wages, making it even harder for people to save for a deposit. For example, in cities like London or Manchester, first-time buyers need a deposit of over £40,000 to even get started. For many young people, this is a monumental task. A deposit alone is now more than the average person saves in a lifetime. At the same time, the buy-to-let market has been thriving, with investors snapping up properties that could otherwise be affordable for first-time buyers. This further reduces the number of homes available to those trying to buy for the first time, driving up demand and prices even higher. So, what happens when first-time buyers can't afford homes? Demand for properties stagnates, and the market starts to feel the pressure. With fewer new buyers entering the market, house prices will begin to drop, and we could see a wave of affordability issues spreading across the UK. By 2026, the lack of affordability could be a major catalyst for the housing market crash, leaving many trapped in renting cycles with no realistic hope of ever owning a home. Number 4. Over-reliance on buy-to-let investors. Over the last few decades, buy-to-let investors have played a huge role in driving up house prices across the UK. With attractive mortgage rates and the promise of passive income, many turn to property as their go-to investment strategy. But now, this reliance on investors is creating serious problems for the housing market. While buy-to-let investments have helped fuel demand for housing, they've also caused property prices to rise beyond what the average buyer can afford. Investors are snapping up homes that could have gone to first-time buyers or families, pushing up prices in already expensive areas. This has led to a situation where ordinary people are priced out of their own neighbourhoods, while investors continue to hoard property. But here's the problem. If the market slows down, these investors could face huge losses. When property prices begin to fall, many investors might be forced to sell off their properties, and this sudden influx of supply will flood the market. The more homes for sale, the lower the prices will go, creating a snowball effect that could crash the entire market. Furthermore, if rents start to stagnate due to an oversupply of rental properties, investors may no longer see the same level of returns on their investments. If they feel the market is no longer profitable, many will try to cash out, adding to the flood of homes for sale. This could lead to a sharp correction in the market, which by 2026 could trigger a buy-to-let bubble burst. The key takeaway here is that the UK's housing market has become dangerously over-dependent on investors. When they pull back, the whole system could collapse, and those left holding the property will face huge financial losses. We put a lot of effort into bringing you this valuable information, and we'd love to hear what you think. Drop a comment below. Do you agree with our predictions about the housing market, or do you have a different outlook? Subscribe to our channel for more insightful videos. It's just one click and it means the world to us. Number 5. The end of government support programs. For years, government schemes like Help to Buy and stamp duty holidays have been propping up the housing market, helping many first-time buyers get their foot on the property ladder. But here's the reality. These programs won't last forever. In fact, many of these schemes are expected to phase out or be heavily restricted in the coming years, and by 2026, we could be looking at a market without the crutches of government intervention. So what does this mean? Well, without these incentives, many potential buyers will struggle to afford a home. Help to Buy, for instance, allowed people to buy new homes with just a 5% deposit, making home ownership more achievable. But once these programs end, first-time buyers will find themselves facing much harsher conditions, with larger deposits required and fewer options for affordable mortgages. The stamp duty holiday, which temporarily reduced or eliminated the property tax for home buyers, was another lifeline for many. But with these tax breaks vanishing, buyers may find that their purchasing power is dramatically reduced. Suddenly, homes that were once affordable could become out of reach. Fewer buyers will enter the market, and without the boost from these government schemes, demand will likely drop significantly. When fewer people can afford to buy, prices will inevitably fall. Sellers who are relying on these government-backed schemes to drive sales will find themselves stuck with unsold properties. As demand shrinks and prices decline, the market could enter a downward spiral, with more homeowners unable to sell without taking a financial loss. By 2026, the end of government support could be a major tipping point for the housing market, pushing it into a major correction. If you're thinking about buying, now might be the last chance to take advantage of these incentives before they disappear for good. Number 6. Economic uncertainty and recession. The UK economy is facing an uncertain future, and economic downturns have historically been a key factor in triggering housing market collapses. With rising inflation, mounting national debt, and the possibility of a recession on the horizon, the housing market is not immune to the turbulent economic conditions ahead. When the economy falters, consumer confidence takes a hit. People become hesitant to make major financial commitments like purchasing homes, especially when there's the looming risk of losing their job or seeing wages stagnate. In a recessionary environment, unemployment typically rises, and wages often fail to keep pace with the increasing cost of living. This means fewer people will be able to afford homes, which leads to a decline in demand for property. Additionally, during recessions, banks become more cautious about lending. They tighten their criteria for mortgages, making it harder for people to get loans. Even those who can secure a mortgage will likely face higher interest rates or stricter repayment conditions. For many, this will simply make homeownership unattainable. As demand for homes wanes, property prices inevitably begin to fall. Sellers, faced with fewer potential buyers, will lower their prices in order to sell their properties. This will not only affect those trying to buy, but also those who already own property. Homeowners who have seen their properties increase in value over the years could find themselves in a position where their home is worth less than they paid for it, potentially trapping them in negative equity. By 2026, the impact of economic uncertainty and a potential recession could trigger a full-blown housing market crash. As job losses rise and economic stress mounts, the housing market will be hit with reduced demand, leading to price corrections that could be severe. If you're looking to buy or sell, now might be a good time to assess your strategy before the storm hits. Number 7. Changing demographics and remote work trends. The way people live and work has undergone a dramatic shift in recent years, and these changes are having a profound impact on the housing market. One of the biggest shifts is the rise of remote work, a trend accelerated by the pandemic. Before, most people were tied to urban centres for work, but now, with more companies offering flexible work-from-home arrangements, people have more freedom to choose where they live. In the past, cities like London, Manchester, and Birmingham were considered the prime locations for housing. However, the rise of remote work has led to a mass migration away from expensive cities to more affordable suburban and rural areas. People are now prioritizing space, greenery, and a better quality of life, rather than proximity to the office. This shift has led to a boom in property demand in these less expensive areas, which has driven up prices. However, this surge in demand won't last forever. By 2026, we may see a reversal of this trend. Many companies are now asking employees to return to the office, at least part-time, and the allure of remote work may begin to fade. As a result, many people who moved away from cities might find themselves returning to urban centres for work opportunities, causing a reduction in demand for homes in the suburbs. Additionally, younger generations are showing less interest in home ownership. The rise of social media and digital nomadism has made renting more appealing to younger people who value flexibility and freedom. As this trend continues, millennials and Gen Z may be less likely to invest in property, further decreasing demand for homes. By 2026, the shifting demographic trends and the evolution of work could leave a significant impact on housing prices. The rural and suburban property boom might slow down, and the market could see an influx of empty homes, further driving down prices in areas that were once hot. If you're looking to buy or sell, it's important to keep these shifting trends in mind, as they could shape the future of the market. Number 8. Global market influences. The UK housing market doesn't operate in isolation. It's deeply interconnected with the global economy. As a global financial hub, foreign investment plays a significant role in the property market. But what happens when international factors start to shift? By 2026, changes in global markets could have a major impact on UK property prices, and the signs are already showing. For one, currency fluctuations can make the UK housing market less attractive to foreign buyers. If the value of the British pound weakens, it can make UK properties cheaper for overseas investors. However, this can also have a negative effect. A weak pound could lead to less foreign investment overall if investors begin looking elsewhere for more stable markets. When foreign investors pull out, it creates a vacuum in demand for luxury properties, especially in cities like London, where international buyers are a major driving force behind house prices. Beyond currency, global economic issues, such as trade disruptions, inflationary pressures, or the impact of international crises, can also send shockwaves through the UK housing market. For instance, if there's a global financial crisis, foreign investors may choose to withdraw their capital from riskier markets, such as property. This withdrawal would likely lead to a drop in housing demand, especially in high-end markets that rely heavily on international buyers. Additionally, changes in foreign property laws or taxes can influence overseas investment. If countries tighten their restrictions on property purchases by foreign nationals or increase taxes on foreign investors, this could result in a significant decline in overseas demand for UK properties, especially in sought-after cities like London. Global market influences are often unpredictable, but they can have a profound effect on the housing market. By 2026, if global instability rises, we could see a sharp decline in foreign investment in UK property, leading to a correction in housing prices. If you're looking to buy or sell, keeping an eye on the international economic landscape could give you crucial insight into future market trends. Number 9. Increase in property supply. For years, the UK has faced a housing shortage, with a mismatch between the demand for homes and the supply available. But the government and various developers have been ramping up efforts to build more homes. While this might sound like a good thing, the rapid increase in property supply could be one of the key factors that triggers a collapse in the housing market by 2026. Here's the problem. When more homes flood the market, there's a chance that supply will begin to outstrip demand, especially if demand for housing weakens, which it likely will due to rising costs, economic uncertainty, and reduced affordability. Right now, developers are focused on building as many homes as possible to meet the government's housing targets and to cash in on a booming property market. But if the economy slows down and people can no longer afford to buy, these newly built homes could remain unsold. Oversupply will begin to have a ripple effect. As more homes sit on the market without buyers, sellers will be forced to reduce their prices in order to compete. Newly built homes are often marketed at premium prices, but if there are too many of them and not enough buyers, these properties will lose their value quickly. This could lead to a sharp correction in property prices across the market, from affordable starter homes to high-end luxury apartments. Even worse, many of the homes currently being built are in areas that are already oversaturated, such as parts of London, Manchester, or other large cities. With so much competition in certain neighbourhoods, properties may end up lingering on the market for months or even years, forcing developers to cut prices drastically in order to attract buyers. By 2026, the surge in property supply could create a supply-demand imbalance that drives prices lower. With too many homes and fewer buyers, the market could face a major downturn, making it harder for homeowners to sell and potentially crashing prices across the board. Number 10. High levels of personal debt. The UK is currently experiencing a debt crisis, with personal debt levels reaching record highs. From credit cards to student loans to mortgages, many people are carrying significant debt burdens. This issue isn't just a financial concern for individuals, it has a direct impact on the housing market, and by 2026, it could be one of the driving forces behind a massive market collapse. First off, rising debt means that people have less disposable income. When your money is tied up in repaying loans, you're less likely to save for a deposit or commit to long-term financial investments like a home. The more people struggle with debt, the fewer are able to buy property, reducing the overall demand in the housing market. But it's not just potential buyers who are affected. Existing homeowners are also feeling the pressure. Many have taken out larger mortgages during the property boom of the last decade, often with the help of easy lending practices. However, as interest rates rise, these homeowners may find it increasingly difficult to meet their monthly repayments. This is particularly concerning for those who are already stretched thin with credit card bills, student loans, or car loans. If mortgage payments become too high, some may face defaults and repossessions, flooding the market with more properties for sale and further driving prices down. The level of personal debt in the UK is not sustainable in the long term. If people continue to rely on credit to fund their lifestyles or buy homes, the housing market will inevitably suffer when economic conditions worsen. Debt-driven demand has pushed prices up, but once debt levels become unsustainable, the inevitable correction will bring prices back to earth. By 2026, we could see a wave of defaults, repossessions, and a significant reduction in buyer confidence. With many unable to afford mortgages or new properties due to their debt, the UK housing market could be left reeling from a sharp downturn as consumers become increasingly overwhelmed by their financial obligations. So, there you have it. 10 powerful reasons why the UK housing market is on track to face a significant collapse by 2026. From rising interest rates and skyrocketing property prices to economic uncertainty and unsustainable debt levels, the writing is on the wall. It's clear that the housing market is facing a perfect storm of factors that could cause it to implode in the next few years. But what does this mean for you? Whether you're a first-time buyer, a homeowner, or an investor, the landscape is shifting fast. While it's impossible to predict the future with certainty, one thing is clear: the market is likely to experience significant correction. If you're not prepared, you could face financial hardship or missed opportunities. So what can you do about it? Keep reading to find out how to safeguard your financial future in the face of these looming changes. While the housing market may be heading for a collapse, there are steps you can take to protect yourself and even thrive in a downturn. Here's what you can do to navigate the uncertainty. Understand your finances. First and foremost, take a close look at your financial situation. If you're considering buying a home, assess your current debt levels, income, and long-term stability. Avoid overstretching yourself with a mortgage you can't comfortably afford. Make sure you have a solid emergency fund and savings for the future. Consider renting before buying. If you're unsure whether now is the right time to buy, consider renting for a while. The market may be volatile in the short term, and waiting could give you a better opportunity to purchase at a lower price once the market corrects itself. Invest in other assets. With the housing market uncertain, it might be wise to diversify your investments. Look into stocks, bonds, or other forms of real estate investment that don't depend on the volatile housing market. Stay informed and adapt. Finally, keep a close eye on the market's changes. Economic shifts, government policies, and interest rate changes can significantly impact the housing market. Being adaptable and informed will allow you to make smart decisions in an unpredictable environment. By taking proactive steps, you can protect your wealth and possibly take advantage of opportunities in a down market. Knowledge is power, so stay ahead of the curve. We put a lot of effort into bringing you this crucial information, and we'd love to know what you think. Drop a comment below. Do you agree with our predictions, or do you see a different future for the UK housing market? Don't forget to check out our previous video for more insights. If you found this video helpful, please subscribe to our channel. It's just one click, and your support means the world to us.